Hey, welcome back. It's Jason Walter here. In today's housing market update, I have a ton of information to share with you today, so I'm very excited to do that. Before that, please subscribe to this channel if you haven't done so already, because I post videos about how this pandemic is affecting our real estate market. And thank you everyone who has subscribed to the channel. I really appreciate your support. And also, please hit the like button if you appreciate real estate market updates just like this one. Okay, let's go ahead and dive right into the video, and I'm going to share my screen with you today. So the first thing I want to go over today is a report by the Mortgage Bankers Association, or the MBA. They just released this report November 2nd, which is the day of this video, and they report that commercial and multifamily mortgage delinquencies have been declining. So that's the first thing I'm going to be going over with you today. Then I'm going to be going over a report by Yelp, which is their local economic impact report as of September 2020. And then I'm going to go over a report from Black Knight that stated that mortgage originations are going to surpass $4 trillion this year, and that'd be the first time ever. All right, so going back to the MBA's report that mortgage delinquencies have been declining. Again, this is for commercial and multifamily only. So they report that delinquency rates for mortgages backed by commercial and multifamily properties declined in October. And this is a monthly survey to gain a better understanding of the ways that this pandemic is impacting or not impacting commercial mortgage loan performance. So according to Jamie Woodwell, who is the MBA's Vice President of Commercial Real Estate Research at the MBA, they said the share of loans newly delinquent fell again in October, but a larger share of non-current loans shifted to later stage delinquencies. I'm going to go over that here in just a little bit because this is very interesting. They said that fewer loans are becoming delinquent, but those that are delinquent are showing fewer signs of curing. So they have a really great graphic on their website here that shows by different sectors. Again, this is only commercial and multifamily loans. So for office, retail, apartments, student, seniors, single family residences, industrial, lodging, as you can see here, high rate of delinquencies, then health, other, and then total. Okay, so this is delinquency status by property type and share of total unpaid principal balance. And this is for April through October 2020. So as you can see here on this graphic, retail and lodging are especially high. But what really caught my attention was here's green. This is up to 30 days late. As you can see, that number has been declining for retail as well as the lodging industry. But when you look at loans that are 90 days plus delinquent but are not in foreclosure yet, those have been really increasing. As you can see here, the number of loans here that are 90 days plus late has really been increasing here. This is the bright orange. Especially when you look at the lodging industry, because 90 days delinquent was right here, but then it's steadily been increasing as we approach October. So it's definitely something to follow as the months progress, and also as the COVID-19 cases are progressing, and some countries like the UK are enforcing lockdowns again. So how is that going to affect the lodging and retail industry if we have lockdowns again in the US? We'll have to see about that. Something definitely to follow at least. So commercial and multifamily mortgage loan performance improved for the second straight month in October, driven by fewer new loans becoming delinquent. But as you can see, the loans that are more delinquent are increasing in numbers. So 94.6% of outstanding loan balances were current, and that was up from 94.3% in September. So the vast majority of the commercial and multifamily loans are current. So that's a really good thing. So right now, only about 5% are delinquent right now. So 3.4% were 90 days plus delinquent or in REO, and REO stands for real estate owned, which is basically a foreclosure. That was down from 3.5% from a month earlier. And for 60 to 90, 30 to 60, and less than 30 days delinquent, those were all around less than 1% of the those were actually delinquent. So loans backed by lodging and retail properties continue to see the greatest stress, as we saw there on that graphic. They saw a higher share of non-current loan balances entering late stage delinquency. However, the overall share of lodging and retail loan balances that are delinquent fell again in October. So 21% of the balance of lodging loans and 12% of the balance of retail loans were non-current in October. It's a pretty high amount. 21% of the loans that are in the lodging industry are delinquent, which really makes sense because a lot of people are not traveling during this time of this pandemic. Non-current rates for other property types were more moderate and generally were falling, as you can see here by other sectors that were falling other than retail and lodging. They're experiencing a much lower rate of delinquency. And this survey by the MBA was as of October 20th, 2020. And important to note here, this does not encompass every single multifamily and commercial loan product out there, but it does cover $1.8 trillion of loans in October, which represents about half of the total of $3.7 trillion in commercial and multifamily mortgage debt outstanding. So this represents about half of the loans that are out there. And speaking of commercial properties, I actually just noticed that two major mall owners filed for bankruptcy on Sunday, which was yesterday at the time of this video. Those two owners own about 130 malls in the US combined, which is quite remarkable. But they filed for Chapter 11 on Sunday, and that was CBL Properties and Preet, both filed for Chapter 11. But 130 malls in the US just by two owners, pretty crazy. So let's go ahead and dive into this report by Yelp. Everyone knows Yelp as a company you can go to or app you can go to look up reviews of restaurants, for example. But they also have a what's called a local economic impact report. And so I found this for September 2020. I would imagine that October would be released soon. But I want to go over this with you here at the high level. And then I'm going to be going over mortgage originations on a residential level. So they say as of August 31st, 163,000 total U.S. businesses on Yelp have closed since the beginning of this pandemic, which they are observing as of March 1st. That's a 23% increase as of July 10th. So they say in the wake of COVID-19 cases increasing, and also we have some local restrictions on in many states on businesses, have forced businesses to either close temporarily or to permanently close. So Yelp says that 60% of those closed businesses are not reopening. So that's about 98,000 that are permanently closed. And they have a great graphic of this. So this is business closures continue to increase nationally. This is as of March 1st. So as of April 15th, 176,000 businesses have closed on Yelp since March 1st. And you see that number actually decreased, but more recently it's been increasing. What's more remarkable are the permanent closures. Those have been increasing ever since April 15th. And right now, again, up about 98,000 businesses have been permanently closed, whereas only temporary closures represents about 65,000. So let's talk real quick about the different sectors that are being affected and least affected by this pandemic. So home, local, professional, and auto services have been less affected by this pandemic. Lawyers, architects, accountants, body shops, towing, contractors, and a lot of home services companies have not been affected by this pandemic. So obviously a lot of people are spending more time at home, are spending time and money on remodeling their house or buying a new house with more space inside and out. And of course, restaurants and retail businesses have been struggling the most according to Yelp. Okay, let's change gears slightly because I want to go over a report by Black Knight. And Black Knight is an analytics firm that provides data analytics to the real estate and mortgage industries. And they just released their September 2020 Mortgage Monitor report. They actually just released that this morning at the time of this video. So they say that the mortgage originations in the U.S. are likely to surpass $4 trillion, and that'd be the first time ever that they have seen this. So let's go ahead and dive into this report. This is for residential mortgages. Let me just show you that at the bottom here. So this is for residential mortgage data, not commercial. This is data covering about 90% of U.S. residential properties at the zip code level. So they are looking at this at a high level overall in the U.S. So they state that Q3 2020 will set new quarterly records for refinance, purchase, and total origination volumes. The estimated origination volumes are on the underlying locks. Underlying locks meaning someone has entered into or has applied for a loan and they're locking the rate in. They suggest that Q3 refinance and total originations could be up 25% or more from Q2, with purchase lending could be up 35% or more. And I'm going to go over that here just a little bit as well because they talk about home prices here. So this would push the 2020 purchase lending activity to the highest level since 2005, and both refinance lending and total origination volumes to their highest levels ever, with total lending on pace to easily eclipse $4 trillion for the first time ever. I personally did a refinance of my mortgage a couple of months ago, refinance for 2.675. It's absolutely crazy. Quite remarkable how low interest rates are. So the Black Knight also reported that at the low rates with improved affordability, which I don't know if we've had improved affordability. We definitely had lower rates, but home prices have been increasing at a very high level. So I'm not too sure if I really agree with improved affordability, maybe early on this year. However, they say that low rates, improved affordability, and low inventory continue to put upward pressure on home prices. And they state that the median home price has rose 14.2% in September. Really important to note here, this is an annual rate. Home prices did not go up 14.2% in September. In fact, when you look at the National Association of Realtors, so National Association of Realtors reported that the median existing home price was up 14.8% from September 2019. And of course, this is due to record low interest rates and very, very low housing inventory. In fact, housing inventory is down 19.2% when you compare it to 1 year ago. So we are seeing home prices going up quite a bit, home sales going up, even though we have very low inventory historically or on average in the US. In addition, also when you're looking at interest rates, let's look at the last 5 years. So right now we're at right around 2.8% for a 30-year fixed rate mortgage in the US on average. So ever since November, as you can see, November 2018, interest rates have been absolutely falling to its record low interest rates right now of around 2.8%. But going back to this report from Black Knight, just want to make sure we're clear. This is 14.2% on an annual basis, not just in 1 month. I think everyone would sell their house if it went up 14.2% in 1 month. Anyways, this is up from 11.5% increase in August. We're talking about the median home price. That's the highest such annual home price growth rate in more than 15 years. Black Knight also reported that despite heavy pandemic-related headwinds earlier in this year, obviously during a time when a lot of businesses were closed, realtors weren't allowed to meet with their clients, they said that home price appreciation has remained remarkably robust. The annual home price growth rate had slowed to 0% in May of this year, the first time home prices were flat year over year since early 2012. But as we all know, home prices have been absolutely skyrocketing ever since then because we have record low interest rates and low inventory right now. And that is today's housing market update. So I hope you enjoyed watching this video. I definitely enjoy making these videos. This is not my full-time job, but if you enjoyed watching this video, please hit the like button. I greatly appreciate that. And also, if you haven't subscribed already, I invite you to subscribe and join the family. You also can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day, and I look forward to seeing you on the next video.